Here we go again. I'm Thomas, and in this video I'll cover a new milestone in the life of the trade on the market and the most important information that I can share with you right now about why large cap companies could be in trouble until the end of the year. So before we dive into the weekly usual report, let me share with you a huge improvement on our website which will be available from Monday. The Trade on the Market team is constantly working to become a full-fledged information and educational platform. At the beginning of this year, our website was created, we were published in English, as you can hear now, and many other things happened. But this week we reached another important milestone. From Monday, the news section of the Trade on the Market website will be launched, where we will share a lot of colorful information with you so that you can fully understand all segments of the market. And those who make it understand it. You will find everything from breaking news through complex macroeconomic analysis to crypto projects on this page, so we look forward to seeing you. Monday is the day, so come and visit us. And now let's talk about maybe one of the most important week in the macroeconomics, which could determine the stock market for the rest of the year. I mean, not only this week, but obviously we're going to get some kind of data which is really important, and I'm going to let you know. So starting with Monday, there is not a lot to talk about. The only one, maybe a little bit important data, is the consumer confidence coming from the European Union, but this will not have a huge effect on the European stock market. However, when we move into Tuesday, I was shocked as well. This is PMI day, and there is a lot of PMI data coming from Australia all the way through to France, Germany, the United Kingdom, and of course the United States. And in today's video, I would like to dive into the PMI data because there is something those data show us, and you need to understand that. And let's start with the French. So last month, the French manufacturing PMI fell dramatically. And considering that we are talking about the second largest economy in the European Union, this is a great indication of the slowdown in the Union's economy. As we know, optimism begins above 50 points. Here, as with all charts, the data is moving in trend, which is not surprising as the economy will not change radically from one moment to the next. The success of production suppression is a great focus for less and less production availability in the near future, so from a living standard point of view, shopping will start to become harder, at least until the end of the year. Approach from another side, this is a forced reduction of buying habits, which will push down inflation. Or at least we hope so. Since the core CPI data in the Union is not too good, or rather too high and still rising, this could be a hold point. But the other side of the story is the increasingly important services PMI. Therefore, a trend-wise decline can be expected from the French manufacturing PMI at least until the end of the year, and the expected data will also align with this. Of course, this has a negative impact on the euro exchange rate in the long term. But I mention again, this is not the only data that has an effect on it, so it needs to be weighted among the data. The last reading was 45.5. Correctional increases may occur, which slightly takes away the negative pressure, but fundamentally I expect a decline from this in the subsequent data. Basically, I expect worse or stagnant data in May. But let's see the other side. The services sector has been gaining more and more ground since the turn of the century, considering technological advancement. Therefore, its influence is becoming increasingly significant both in terms of inflation and GDP. The services PMI is a piece of data that alongside the manufacturing PMI can be quite decisive when considering the value of a currency. Not just in the short term, as rapid-fire traders react immediately upon the data release, but the trend of the data is even more important as it has a long-term effect. And this is where significant differences lie. While the manufacturing PMI data facilitates the devaluation of the currency with a trend-wise decline, companies strive to maintain their revenue with services during economic slowdowns. This will work for a while as long as people can pay for the services. But as the belts tighten, this will become increasingly difficult. The French services sector is currently perfectly healthy, but continuous interest rate hikes result in higher loan interest rates at banks. therefore making it increasingly difficult to maintain this company strategy as well. I also expect a decline in this sector in the long term, but it is conceivable that if companies can maintain this tactic for a long time, the sector's decline will not be so significant. We are currently at 56.6, following a correction, because originally it was 56.3, which is rising and positive. However, it is important to note that during the post-pandemic economic shock period, the services sector could not perform better than the zone between 56.1 and 59 points. Since we have arrived into this and the revenues reported by companies are also worsening compared to the previous quarter, I think a slowdown will follow, then from that a decline, which procedure could turn the trend over in 3 to 4 months. At that point, we will have to deal with more serious corporate revenue losses, and since, as I mentioned, companies offset the revenue shortfall from production losses with this sector, the decline could cause serious damage to the stock market prices as well. Therefore, in the current economic situation, we have received a perfect indicator in the person of the services PMI, and we will examine whether the EU data or the German data can also serve such a role. Spoiler alert, yes, they do. If so, we are in a very good position to determine when the stock market might enter a sadder period. Of course, I've already presented one of these last week, so we have more and more usable weapons for prediction in the current situation. With the interpretation of the French data in mind, we can state that the manufacturing sector in the European Union's largest economic region, Germany, is also in a very bad situation when it comes to the manufacturing PMI. Let's not forget that the score below 50 indicates poor prospects. Therefore, the surveyed corporate managers predict poor production performance based on their own performance and forecast, and moreover, this is forward-looking data. If it's negative, it means the performance of the next month will be negative, but not the finding of the previous one. Well, in the case of Germany, this decline started earlier than in France. The decline is also more stable. After a correction from 44 points, we read 44.5 points. The trendwise decline continues, and we can see that expectations completely miss reality, so don't focus too much on how the data turn out compared to the expectation, because the expectation itself is far from reality. However, it is very important what the new data is compared to the previous one, which was worse than last month in this case. There can be minor correctional increases here as well, as we experienced in November and December due to the Christmas preparation, but in reality, further decline is expected due to the trend-wise nature, as it happened before. That's why I expect a declining trend here until at least the end of the year. The reason it's until the end of the year is because the economic slowdown caused by interest rate hikes can only ease if interest rate cuts occur, followed by a reaction time when the economy can breathe again. But this can only start after the inflation rate has been pushed down, which we are far from. So even the minimum end-of-the-year prediction might be a bit too optimistic. And surprisingly, in line with the French data, the services sector in Germany also improved for exactly the same reason. So currently it is growing, and there is a zone here too that could indicate a slowdown in growth or reversal. This is between 56.7 and 58 points. We are not far off. The previous data was adjusted from 55.7 to 56, so we could move into the zone in just 0.7 points. If the slowdown or decline in growth really begins in the next 4 months, which is not a requirement, but it would be logical, it would prove the French data, which we look at the next to see what impact it could have on the EU zone and the currency. So the rise might still occur mildly, but the turnaround could happen very soon. Everything depends on how long people can stretch with existing jobs, inflation, and savings. But that's not all. So the aggregated European Union PMI data perfectly reflects the results of the two strongest economic regions, and it is in decline. It's a trend with a new low point following the last result of 45.8, and I anticipate further decline or stagnation. As I mentioned with the previous data, A correction here is not surprising, but eventually the trend will prevail until it breaks due to improving economic conditions. You know the scenario, we need low inflation for this, then an ECB pivot, then time for the economy to react. Until then, this data exerts a negative impact on the euro exchange rate, and let's not forget two things here. One, the services PMI also has an impact on the currency, so we need to consider the balance of the two, and we haven't even talked about the other data that affects the currency, which we discuss daily at the pro level, but you will soon get to know them with our macroeconomic lexicon on the website, which will be available free. And two, the decline of the data is to be understood in a long term, and this will be important for the next piece of data. So then there is the PMI data for the services sector, which also reflects the French and the German data. In fact, the growth here is even more aggressive, as both regions have seen aggressive increases separately. We know that the services PMI data for the two most important regions will soon rise to a level where they could turn down, assuming the economic squeeze does not ease. And it will not ease. We know that the manufacturing PMI data accounts for a long-term decline. Therefore, if this data starts to worsening, it could signify the collapse of the entire supply sector, which is kind of necessary during a recessionary period. So if this data starts to decline, we could experience a serious negative impact on the stock market, as this is when the period begins where companies are no longer able to cover the weakness of the manufacturing sector with the services sector. And we talked about how this could last until at least the end of the year, but probably longer, so at this point investors will pull the rug as hard as they can. But funny though, PMI data are also coming from the British, and it's very interesting to observe all that I've been indicating to you for weeks. Since the British are simply unable to slow down the economy to the same extent as the Union, otherwise they would starve to death due to export-import difficulties, their manufacturing PMI cannot decline to the same extent. It's negative, but to a mild degree compared to the EU data, and instead of continuous sinking, it only consolidates between 45 and 50 points. However, as long as this data does not move out of this zone, it will not have a significant impact on the currency, so we are really only considering it as an economic indicator at the moment. At the same time, this is very important information for intraday forex traders, as it tells them not to expect the usual reaction at the time of the data relays, what we experienced usually before. However, in the case of the services PMI, we are observing exactly the same as in the case of French, German, and the EU data. There is also an increase here. There is also an upper limit, which is 60 points. Here too, we can expect a slowdown or decline at this point, or close to it, but here comes the big twist. So think about it. The poor Brits are fighting to prevent further decline of the manufacturing sector. They are more or less fulfilling this. But what will happen if the services PMI data crashes and pulls down the manufacturing data with it? Armageddon, end of the world, maybe universe destruction, it doesn't really matter. It's already lost case because we do not have a good scenario for the United Kingdom at the moment. And then we arrive at the United States manufacturing PMI from the production sector, and something immediately catches your attention, or at least my one. What did we see in Europe? Declining PMI, long-term downward trend, ominous signs due to services sector data. And what do we see here? See, yes, something different. Specifically, the PMI data has been rising for the 5th month, and not only it's rising, but it has lifted itself out of the negative zone, and the last reading was 50.2 points. Not too high, not too positive, but positive. And this means that the production sector expects improvement at the start of the summer. At this point, please remember my video from last week about what this could cause. If you haven't seen, or you don't remember, quickly review it. Do you want to be a stock market expert? Here I am giving you the weapon to become one by explaining how the economy works. So at this point, while the rise has a positive effect on the exchange rate of the US dollar, it has a very negative effect on the economy, as it could further increase inflation. But hold on, Because, and this is very, very important, the services PMI is important for the same reason as in the case of the European data. After all, the circumstances have not changed, and the companies are heavily pushing services. With this data, you now have the perfect recipe for cooking up the economic pie. The question is, how hungry are you? So interestingly, as a twist, I am now waiting for your calculation in the comment section based on what I said about the European data. And of course, on this day, we're going to get some new home sales from the United States, but that is less important next to so much PMI data, which is really, really important, by the way. On Wednesday, we're going to get New Zealand official cash rate, CPI numbers from the United Kingdom, and of course, some Fed meeting, which, that's always a trouble. And Thursday, US prelim GDP, US unemployment claims, and US pending home sales, which we need to check out. By the way, I just forgot to mention, but usually I do, that those times are Central European times. So if you're watching us from the United States, then you're going to get in another time zone. And then here comes Friday. Friday, we're going to get Tokyo Core CPI from Japan and US Core PCE Price Index, which is the two most important. And they're going to be consumer sentiment and the inflation expectation from the United States. From that, inflation expectation will be one of the most important, just so you know. So to wrap up what happened or what's going to happen with these PMI data, it is very important to understand completely. So what is happening is that companies which normally make a living from production and distribution, so the majority of them, are now able to beneficially exploit the services sector due to the advancement of technology to cover the losses resulting from the slowdown in the production. This, of course, has come about due to high raw material prices, interest rate hikes, and high inflation. By prioritizing services, they can still target people's savings, but because unemployment increases, loan interest rate increases, savings are about to disappear, so I smell some trouble. In addition, overall corporate revenues are also declining compared to the previous quarter, which can be clearly seen from the new earnings data. So corporate revenues are now only insured by the services sector. And since the interest rate hikes do not stop, if the services PMI data falls, a large part of the companies could quickly go bankrupt. This could also contribute to a rug pull. Last week I explained how we can infer trouble from 3 pieces of data, and today I have added another one for you. For this, you can see how important macro data is. Their significance and impact constantly change with changes in the economic condition, but in the current situation, they can be excellently interpreted. So I hope the information I was provided was useful for you. Remember, at the pro level, we analyze every major macro data and draw proper conclusions when they arrive. If you want to join us, visit our website, link in the description. And don't forget the launch of the news on our website as well from Monday. In the meantime, I would love to hear your thoughts and opinions in the comment section. If you want to stay informed about next week's data and other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. Until then, see you in the next video.